If you've followed financial markets for, the last decade or so, you probably developed a pretty dismissive view of silver.
Oh, absolutely. Frustrating is the
It
word.
was so frustrating, right? For years, it was just the volatile sideshow, the metal that consistently lagged the big stock indices, and maybe more importantly, it often failed to confirm gold's big rallies.
Right. It just reinforced that reputation as, less reliable than its shiny cousin.
But then 2025 happened, and it was like a massive turning point. The script completely flipped.
Hmm.
Suddenly, you had silver setting new highs in, well, all the major global currencies, and it wasn't just keeping pace with stocks, it was outperforming them.
And this wasn't some kind of blip. This was happening while the market was fundamentally struggling to meet demand. It was operating in a chronic, persistent structural deficit.
So our mission today is to do a deep dive into this tectonic shift. We're going to analyze the forces at play in 2026, geopolitical, technological, geological, all the things that have moved silver from being, an afterthought
To arguably the single most important strategic metal right now.
Exactly. The one intersecting the energy transition and all this global financial stress. Okay, let's unpack this.
Well, what's really fascinating here is that silver now has this rare, really powerful position.
Okay.
It sits at the absolute intersection of two massive, you could say, unstoppable macro trends.
New trends, what are they?
So first, you have the relentless global energy and technology transition. I mean, silver is just non-negotiable for solar panels, for electric vehicles, for high-spec electronics.
The industrial side.
And second, you have these mounting, really systemic concerns about debt, inflation, and financial stability. That's forcing silver to reclaim its historic function as a monetary metal, a store of value.
So it's a dual mandate metal now.
It is. And both of those mandates are converging on an incredibly tight physical supply.
Let's start with that tightening, because for, what was it, about 11 years? The source material calls it a long stalemate.
A stalemate is a great word for it.
Gold and silver just traded in these broad, frustrating, kind of horizontal ranges against the S&P 500. It felt like walking through cement.
Yeah, it did. Metal investors were just constantly waiting for that breakout that never quite seemed to stick.
But then that stalemate it shattered in late 2025.
It really did. And it wasn't just silver. The whole complex, gold, silver, even the gold miners, they all broke out decisively against broader equities.
So what did that look like to analysts?
Well, when they looked at the technical data, it didn't look like a climax. It wasn't some kind of blow-off top. It looked more like a constraint had just been removed.
Constraint.
Yeah, like a heavy lid was finally lifted, allowing silver to really reflect all these fundamental pressures that have been building up underneath for years.
And as the prices pushed higher through 2025 and into 2026, we saw the immediate real-world consequences of that pressure.
Right. The actual mechanics of the market started to show some serious strain.
That's where it gets really interesting for me.
Absolutely. The first sign of real trouble was how frequent the liquidity stress was. We saw these repeated, pretty severe periods of backwardation.
Okay, we need to pause on that term, backwardation,
Yeah.
because it's a huge signal.
It's critical. So backwardation means the price for immediate physical delivery, the spot price, is higher than the price for delivery in, say, 3, 6, or 9 months.
Wait, that feels counterintuitive. Usually you'd pay a premium to have someone hold something for you and deliver it later.
Exactly. Normally, a market is in contango. The futures prices are higher because they have to include the cost of storage, insurance, financing, all that.
Right.
When a market flips into backwardation, it means people are willing to pay a premium just to get the physical metal right now.
So they value availability over the future cost.
Yes. It's a sign of intense short-term tightness.
It's like paying extra for the last bottle of water on the shelf during a heat wave, even though you know the delivery truck is coming tomorrow.
That's a perfect analogy. And alongside that backwardation, the exchange vault inventories were showing major stress.
Right. The stockpiles.
We saw these huge drawdowns as large deliveries were just pulling available stocks right out of the public domain.
Yeah.
And these signs of stress are all happening against that deeper context you mentioned, those persistent structural deficits.
So the market just keeps having to pull from its buffers year after year.
And eventually, those episodes of tightness, they become the norm, not the exception.
So let's define that core constraint then, the structural deficit. What exactly does that mean, and how long has this been going on?
Okay, so a structural deficit happens when the underlying physical demand from Industry, jewelry, investment, all of it is persistently higher than the combined supply from mines and recycling.
Which forces a draw on the world's above-ground stocks.
Precisely. And the critical fact that really frames this whole story is that the global silver market has been in this deficit state for multiple consecutive years.
Wow.
It isn't a cyclical shortage, it's a deep structural imbalance.
And I guess at first, those deficits are manageable. You use the cushions, the inventories you've built up.
Right. But eventually those easy-to-access stocks are just gone. Or they've been locked away in long-term holdings, which makes the market hypersensitive to any new shift in price or demand.
Okay, so here's my challenge on the supply side. If the price of silver has doubled, why isn't every miner on the planet suddenly, digging for silver? Surely the market should self-correct.
That's the logical assumption,
Yeah.
and it's where the unique geology of silver really steps in and complicates everything.
How so?
The structural reality is that roughly 70% of all the silver mined each year isn't produced from a primary silver mine.
70%.
70. It's produced as a byproduct of mining other metals, specifically copper, lead, zinc, and gold.
Wow, so silver is basically just riding in the passenger seat of the copper market. It can't really drive its own destiny.
That is a perfect way to put it, and the implication is huge.
I bet.
Higher silver prices are great, they're helpful, but they don't automatically trigger a wave of new silver production. The core decision to, finance, build, or expand a mine is still anchored in the economics of the primary metal, the copper or the zinc.
So if copper prices drop, those miners slow down, and silver supply just drops right along with it, no matter what silver's price is doing.
Exactly. And even if you do look at the few primary silver deposits, the analysis confirms that grades have been steadily declining for years.
Right, and bringing any new mine online, even a profitable one, still takes years and years for permitting, for development, for massive capital outlay.
You just can't fix a multi-year deficit overnight.
What about recycling? This is where I think the challenge comes in. If we're using all this silver for the green transition, why can't the green transition itself solve the recycling problem?
That's the other key piece of the puzzle.
I mean, why don't we just mandate better end-of-life recovery? It seems like an obvious solution.
It does, but it's because of the very long service life of the products we're putting the silver into. The major growth sectors, like solar modules and advanced electronic components, they have lives that often stretch 25, even 40 years.
So the silver embedded in a solar farm that we're building today,
It just won't come back to the supply pool for decades. It's effectively locked away.
it's an inventory of metal that is functionally gone for a whole generation.
Well-
So recycling helps around the edges, but it's fighting against the nature of the products themselves.
Precisely. The time lag is just too immense to close a structural gap in the near term.
Okay, let's shift gears and look at the engine that's turbocharging the demand side. We know silver is the king of conductivity, right? Indispensable for electricity and heat.
The best there is.
So when the price jumps, why don't manufacturers just pivot to something cheaper, like copper?
It really boils down to a performance trade-off, and it's one that manufacturers are fundamentally unwilling to make in their high-value applications. I mean, sure, substitution with copper or aluminum is possible in some low-spec situations, but it almost always means you get reduced performance, higher energy losses, or a shorter product lifespan.
And in critical systems, I'm thinking advanced semiconductors or contacts in an EV, reliability is everything.
It's paramount. The tiny cost savings you'd get from using an alternative are completely eclipsed by the massive cost of a product failure, or even just a small reduction in efficiency.
And the demand drivers here are just relentless. Solar photovoltaics, or PV, is called out as the single fastest growing source of demand.
The numbers are phenomenal. If current trends continue, PV demand alone could exceed 30% of global silver consumption by the end of this decade.
30%, that's more than double its share from just 5 years ago.
Yes, it's a staggering growth curve.
And I want to pause on a nuance within PV tech because the analysis mentioned something kind of counterintuitive. Manufacturers are trying to thrift to use less silver, but
Yeah.
some of the newer high-efficiency cells actually use more.
That's right, and it's a fascinating dynamic. So on one hand, manufacturers are constantly trying to reduce the amount of silver paste they use per cell. That's thrifting.
Okay.
But on the other hand, the market is rapidly adopting these cutting-edge, high-efficiency cell designs, like CopyCon or HJT cells.
Which are what, exactly?
They're just advanced silicon cell structures. They boost the panel's efficiency significantly, but they require much more intricate, finer lines of silver paste to capture and transport all that electricity efficiently.
So even while they're trying to use less silver overall, the move to better technology can actually demand more silver per unit of area.
In some cases, yes. We're kind of stuck on this high-tech treadmill where demand just stays elevated, even with these other efficiency gains.
And we can't forget the other big drivers, electric vehicles for one.
Absolutely. EVs need silver all over the place. Power electronics, battery management systems, sensors, and then there's the whole digitization movement, data centers, 5G networks, AI hardware. They all demand these high-reliability electrical contacts where silver is just essential.
So this all brings us to a really critical concept, inelastic industrial demand. Can you explain why a big price spike in silver doesn't just kill demand from these industrial users?
You have to look at the economics of the finished product.
Right.
In most of these high-tech devices, a solar panel, a complex sensor, the amount of silver used is, well, it's trivial compared to the total value of the item.
So maybe $1 or $2 worth of silver in a device that costs hundreds?
Exactly. You might be using, say, $1 to maybe a few dollars worth of silver per device. So if the price of silver goes up 20%, the overall cost of that final solar panel barely even shifts. For that industrial buyer, the operational risk is fundamentally different. Their biggest concern isn't a slightly higher input cost.
Their biggest risk is not getting the silver at all.
That's it. Their greatest operational risk is not securing enough silver and having to shut down a manufacturing line or fail to meet a huge delivery contract.
So they treat it as a strategic input to secure at almost any cost.
Yes, rather than just a cost to minimize. And that's what makes that industrial demand so incredibly resilient or inelastic to price increases.
That's a fascinating inversion of the usual supply-demand dynamic. Let's pivot now to the geopolitical shifts influencing this. China has historically been this major exporter and refiner, acting as what the analysis calls a quiet stabilizer.
And that stabilizing role is now fundamentally changing.
How so?
Starting this year, 2026, China is introducing a new, much more restrictive licensing regime for its silver exports.
Okay.
They're explicitly signaling that silver is now viewed as a strategic resource. Under this new framework, only certain approved entities can even export refined silver. And crucially, the overall annual volumes might be significantly restrained compared to historical flows.
So if the global market relies on that Chinese refined supply to fill the gap, this is going to create real tightening and probably regional price differences too.
Absolutely. It's a major tightening lever. And at the same time, we have to look east toward India, which is just rapidly rising as a major force.
A force on the demand side.
On both sides, they are driving huge industrial demand with a massive PV manufacturing build-out, all heavily supported by their government incentives. They need enormous amounts of silver for those new domestic panels.
And you said on the investment side too, right?
Yes, we're seeing increased holdings in silver-linked exchange-traded products there, plus rising physical imports. So India's playing this dual role, a critical manufacturer consuming the metal and a growing consumer of investment products. It's fundamentally altering global trade flows, pulling the metal east.
This leads perfectly into the monetary narrative. After years of being just an industrial commodity, silver is suddenly back in the conversation with gold as a hedge. Why now?
Well, you just can't ignore the macro context here. You've got historically high global debt loads, you have extraordinary fiscal deficits in major economies, the US, Europe, Japan, and you have bond market strains that just will not ease up.
Right.
So when the basic sustainability of these fiscal and monetary policies comes into question, it naturally triggers a desperate search for assets outside the traditional financial system.
And silver fits that bill. A tangible asset with thousands of years of monetary history.
Exactly. And the analysis points out this really clear east-west divergence in how that monetary narrative is being internalized.
What's the divergence?
There's a very strong entrenched tradition of holding physical precious metals in many Asian markets. Think India, Singapore, Hong Kong.
Okay.
And this is now translating into very strong silver accumulation. But it's not just cultural tradition. It's rooted in recent history where, rapid currency fluctuations, capital controls, or high inflation made tangible assets a necessity for preserving wealth.
So they have a greater institutional memory of currency debasement.
I think so. And that drives a stronger preference for physical accumulation compared to what we typically see in Western investment markets.
This paints a very, very compelling picture of convergence. You have tech demand meeting geopolitical supply restraints and this flight to monetary safety. But no market story is ever without its risks. What could possibly derail this trajectory?
we have to maintain a balanced perspective. So on the demand side, the biggest risk is probably technological substitution.
A breakthrough.
A breakthrough, exactly.
Yeah.
Research is always ongoing. You could potentially see a major development in material science that yields a viable high-performance substitute for silver in PV or other high-tech applications.
Or new battery tech that's less silver intensive.
Right. If that happens, the long-term intensity of silver use per unit of energy output could just plummet.
And on the supply side, I mean, sustained high prices do eventually win, right? We have to assume that if the price stays high enough for long enough, it will eventually overcome that byproduct issue and incentivize brand new primary silver mine development.
That's the long game, absolutely. And high prices could also force governments and industry to invest massive capital into scaled-up recycling tech and policy. If end-of-life recovery becomes economically and technologically feasible at a massive scale, that could eventually help offset some of the structural deficits.
Then you've got the huge macro risks. What if the global debt situation stabilizes? What if inflation pressures dramatically ease or central banks somehow manage to engineer a soft landing?
If that happens, the urgency of seeking those monetary hedges diminishes significantly. The monetary narrative could weaken even if the industrial demand stays robust.
And policy shifts. China could unexpectedly decide to relax those new export controls.
And that could instantly alter global trade flows, alleviating some of the physical tightness we're seeing right now.
What's so rewarding about this deep dive is realizing that silver's value just isn't determined by one variable anymore. It's this incredibly complex Venn diagram where the price reflects this overlap of industrial necessity, geopolitical strategy, monetary anxieties, and technological change.
The primary value of this analysis, I think, is in framing the right questions for you, the listener. It's about acknowledging that the structural deficits, the inelastic industrial demand, and the geopolitical tightening are all pushing powerfully in one direction.
While potential substitution and macro stabilization are pushing in the other.
Exactly.
That's a perfect distillation. So the key takeaway here is that silver's strategic importance seems undeniable, driven by its critical, basically irreplaceable role in the global energy transition. And at the same time, the supply side is becoming fundamentally tighter because of geology and these new geopolitical decisions like China's export licensing. So as you integrate this knowledge, maybe ask yourself, how might continued sustained bond market strains or maybe new aggressive government energy policies, how might they specifically affect the valuation of tangible assets like silver versus traditional debt-based financial instruments in your own portfolio?
And here's the final provocative thought we want to leave you with, building on the source material. Given the evidence that industrial users view silver as a strategic input to secure and seem willing to absorb higher prices, and given that physical tightness is constantly being revealed through these frequent recurring episodes of backwardation, what is the ultimate operational risk that manufacturers are facing today? Is the market worried about cost, or is the market fundamentally worried about availability?